Mine is kind of a more general question, and I'm actually kind of looking for the best way to analyze approaching a situation. So I have a home mortgage that is way higher on the interest rate than it should be. It was done 11 years ago. Interest rates were much higher, and it is a 30-year mortgage, and the rate might be like 5.25. So I've been needing to refinance it for some time. I have a kind of a greater need now because I have two other commercial properties, one of which the deal is done and another of which the financing is done, but it is in the process of doing the construction on it. And as I think some of you may know who do commercial property investment, the costs always end up being much higher than they were quoted before the project starts. And so I have a desire probably and a possible need based upon the increased cost on the commercial project to maybe pull some equity out of the home as I refinance it. And so I guess there are two questions. One, how should I approach that? How should I analyze the refi of the residential property?
Okay, let's talk about that for just a second, okay? People have been refining properties for a very, very long time, and they generally do it to save money. So here's my question. If you're saving money by refinancing, who has to be losing it?
The bank.
Why would they be in that business?
Why would they be in the business of refining?
If they're losing money.
I don't know. I'm not really sure what you're asking.
Let's find out why banks are in the business of refining. You're in a business, and if you had some product on your shelf, some service that you were providing that was not making you money, would you get rid of it?
That was not making me money, would I get rid of it?
Yeah.
If it was not making me money, yeah, I would get rid of it.
All right. So if banks are losing money by refining, they're very much into it. In fact, what they're doing is every 5 to 7 years, they're filling up your mailbox with offers. They hire people to call you at dinner time. Okay. Then they hire somebody to answer the phone when you call them back. And then they hire somebody to actually put the loan package together. They're spending millions of dollars so that they can lose money. No, let's find out what they're really doing, what's going on with this. I'm putting an amortization schedule. That 5% loan, you said it was 5.125 or something?
Yes, 5.125.
And how much was the loan to begin with?
The loan was originally $400,000, roughly $400,000.
$400,000. We'll start there. Okay.
Yeah.
So here's the payment on that. Okay. So we're doing that $400,000. The principal and interest payment on that is $2,177.95. We're not including the taxes and insurance. Right. Okay. So we're scrolling down to the summary, and in the summary, it's $384,000 in interest they want on that loan. Okay.
Over the life of it.
Over the life of the loan, which is actually 96% of what you borrowed.
Right.
Yeah. So it's not 5.125. It's 96.
Right.
So now let's take a look at payment number one. All right. So here's what you know to be true. When you have a higher interest rate, especially on a commercial property, your principal payments are lower.
You said, say it again.
When you have a higher interest rate, especially on a commercial property, your principal payments are lower under the principal column. Do you see that? So they're starting out in the $400 range, mid $400 range. Okay. So if we take a look at, I'm going to duplicate this, all right, for later. But when I make my payment, only $469 goes to principal, $1,708.33 goes to interest on this. Okay. Now, if this is my very first payment, let's say it's January, wouldn't $471.62 be the February payment? Okay, that would be the February principal payment. So here's my question. We're in January. We just made January's payment. Do we have to wait till February to give the bank an additional $471.62?
No.
If we had it, could we give it to them in January?
Yes.
If we did, all of this money would go to principal, and we'd be paid down to line 2 on our amortization schedule in January. We'd be paid down to $399,058.76. Make sense? Which means our next mortgage payment for February will actually be on line 3 of our schedule. Correct?
Mm-hmm.
So we just got rid of line 2 on our mortgage for just $471.62. What happened to this $1,706.33 in interest on line 2? What happened to that?
The interest goes away.
It goes away.
Right.
So you got rid of it for $471. So let's go over to here to the same loan, but we're going to change the interest rate to about 3.5.
Mm-hmm.
Okay.
Mm-hmm.
We changed the interest rate, and now it's still a 30-year loan, but now the payment is $1796.18, which is lower. We got a lower interest rate, but now look at the principal payment. Look at the principal payment now. To get rid of one line, it's going to cost me $631 to get rid of line 2, where on the other one, it cost me $471. See, here's what the bank knows. When you lower your interest rate, the bank knows it just made it harder for you to pay off the loan faster.
Mm-hmm.
So if we're looking at a 30-year loan, they always talk in terms of 30 years, even though they don't say it. If you're comparing a 30-year loan at 5.25 or a 30-year loan at 3.5, get the 3.5 if you're going to make all 360 payments.
Right. Right.
But if you're going to accelerate, trying to save money in interest and get out of the debt cheaper, you want to control the principal payment so that when you're making those payments, you can knock out more lines on the amortization schedule faster. So let's say you have about $10,000 available in a reserve account. And it says, okay, I want to attack this loan aggressively. All right. So $10,000 on the higher interest loan. Okay, $10,000. I'm going to go to cumulative principal because we can add it all up very quickly. $10,000 knocks out about 21 payments and saves almost $35,000 in interest. Look at that. Okay, $10,000. If I lower the interest rate to 3.5, $10,000 takes me to line 16. And the bank knows that. Okay. So when we are trying to figure out, shouldn't refinance, I never know. But what you want to do is when I run the numbers, whether I'm going to refinance or stay in the loan that I'm in, here's what I want to know. How much is it going to cost me in interest overall to manage this loan for the time I'm going to be in it? That will tell you whether you refinance or not the lower interest rate, not the lower payment, but how much is going to cost you in interest overall to manage the loan. Sometimes it's good to refinance. Sometimes it's not. Okay.
So the fact that interest rates may be bouncing up, they say that the interest rates may go up next month.
Yeah.
Then that really should not factor in.
Listen, it should not dissuade you one bit. In fact, it should encourage you to go ahead. Because here's what's going to happen. Everybody
should encourage me to go ahead and refi.
Oh, if you're going to purchase.
Okay, purchase, but refi, not necessarily.
Not necessarily, because there's so many things we have to take a look at if refining is going to benefit you. Now, if you're cashing out to purchase additional properties, okay, so you don't have to say, let me get this done. Let me hurry up and get it done because before the interest rates go up.
Yeah.
Take your time. Get a good deal. Let us help you to do that so that once we plug everything into our opportunity cost calculator, we can help you to determine how this is all going to play out even before you close. We can run these numbers for you. It says, I got this. We're going to pull this money out. Here's what the interest rates are about now. What can I do with that money once I reinvest that money? All sorts of things. Okay. And how much is it going to cost me to manage that? Our average client pays off all of their debt in 7 to 9 years.
But Don has some valuable information that can contribute to the quality of a person's life. And it only costs you a few dollars. It's his book. Why not get that?
I'm going to go through the P.I.L.L method myself with some of my investment properties. So I'm going to link up with Don, and then I'm going to sit down with him, show him my investment portfolio, and see how I can eliminate interest.